viewers, and welcome to the Bourse Report. I am Marjorie Seaburn, Manager of Equities at Bourse, and I'll be holding on for Cyril this morning. Today, we'll take a look at recently released results for Republic Financial Holdings Limited, as well as GraceKennedy Limited. Firstly, we'll start off with looking at Republic Financial Holdings and their full year results for 2025. Earnings per share was up 9.8%, moving from $12.29 to $13.49. Net interest income was up 7.8%, moving from over $5 billion to $5.46 billion. Operating income up $552 million or 7.7%. Operating profit up 9.4%, and profit before tax up 8.8%. Taking a look at the two main revenue streams of Republic, net interest income and other income, we've seen steady growth in both lines of income over the last 4 years. Over the last 4 years, net interest income has grown over 37%, moving from a little shy of $4 billion to current $5.46 billion. And year on year, the improvement was 7.8%. The group would have benefited from healthy growth in the loan and advances portfolio, which would have moved from a little over $55 billion at the end of 2021 to the current $74 billion. The other income would have grown a little over 23% over the last 4 years, moving from $1.8 billion to $2.57 billion, and year on year would have been up 7.4%, with strong contributions over the last 2 years from net exchange trading gains, credit card expenses growth, as well as improvement in other fees and commissions. Looking at profit before tax contribution by regions, including eliminations, year on year, the Trinidad market was down, but we see positive performance from both the Barbados market and the Suriname market would have doubled their contribution profit before tax. Strong contributions from the EC as well, moving profit before tax from $233 million to $280 million. Steady performance from the Guyanese market. Strong performance from the Ghana market, a recovery there, and the Cayman Islands contribution, the largest after the Trinidad market. Steady performance. Profit before tax moving from $474 million to $486 million. Even though the growth wasn't as significant for the Ghana market year on year this year, over the last 4 years, the contribution from the Ghana market has doubled for profit before tax. And this definitely is one region we could continue to see strong, healthy growth going forward, as well as more contributions from the Cayman Islands with the increased investment in the Cayman Bank. When we look at the performance of Republic against its peers in PE valuation and dividends, we see Republic very much on the very attractive spectrum. The sector average at PE valuation is 8.8 times, Republic at 7.6 times. And this, when you look at historical levels, Republic traded at 12 plus time valuation. Of course, the market dynamics is much different now, but 7.6 is still relatively attractive from a historical as well as sector average. CIBC at 11.6 times, Scotia at 11.3, NCPFG at the lower end at 4.8 times, and the group would have benefited from a one-off sale of one of the subsidiaries, which would have positively impacted their earnings per share and, of course, their PE valuation. When you look at trading dividend yields, the sector average at 5.3%. Republic, not the highest, but 5.9% is quite attractive when you consider banking deposit rates at 3 and 4%, and other fixed term investments. Dividends are also paid on a quarterly basis. The highest dividend yield is first at 7.2% and followed by Scotia at 6.2%. Our recommendation for Republic at this point in time is overweight. We do like the valuation PE at 7.6, the dividend yield higher revenues, the geographical diversification. Less than 50% of their assets are only in Trinidad. So we do see that as a strong benefit going forward as our local economy continues to face some headwinds and the dividend yield is very attractive. Our outlook for the security is a watch, as there are some market uncertainties. The asset level of 25% on the company and other banks would impact the security itself. The impact could be a possible dent in earnings of 6% based on current earnings per share, as well as a possible impact on dividend payments. Lower earnings could mean lower dividends as well. And overall market sentiments continue to be low, not only for the industry, but certain securities as well. So our outlook watch, but our recommendation overweight, as we do think it's a strong security over the medium and long term. The next security we'll take a look at is GraceKennedy. Earnings per share was down 7.7%. Of course, our calculations would have been converted to TT dollars. Earnings per share was down to 26.8 cents, down from 29 cents a year ago, the 9 months result. Total revenue on the positive side up 5.9%, moving from 5.5 billion to 5.8 billion. Expenses, however, was up more than revenue at 7.2%. This would have impacted overall performance. Profit from operations was down 9.4% and profit before tax down 7.5%. When we look at margins, and this will tell the story of why Grace would have suffered in the 9-month period, the operating profit margin fell to 6.6%, the lowest over the last 5 years, and down from 7.7% a year ago. And the TD Group have been able to hold its operating profit margin over the 7% level over the last few years. Unfortunately, this year, the impact of warehousing and logistic problems have impacted primarily the food and trading segment, and this has contributed to the overall weaker performance for the group. The company did indicate that there has been some resolution to the warehousing and logistic problems, and the impact should be minimal going forward. When we look at profit contribution by segment over the last few years, the largest segment continues to be the food trading segment. Unfortunately, year on year, this segment has been down. Earnings, profit before tax falling from 268 million to 256 million. This despite a growth in revenue of 5.8%. The next strongest contributor, money services, continued its decline since the last few years. Year on year, profit before tax falling around 25 million over the 9-month period. This following a dip in revenue growth as well, down over 5%. The two other segments, contribution continues to see growth, marginal but positive, in the positive direction. The banking and investments and the insurance segment. And the insurance segment would have benefited from a 14% revenue growth. Our recommendation for the security at this point in time is market weight. We see steady revenue growth for the company despite various challenges with expenses. Attractive factor, US dividends, and dividends are paid on a quarterly basis. The yield is not as attractive as the sector average of 3.7 at 2.8%, but still relatively decent, and you are getting US dividend yields. And the PE valuation at 10.7 compared to the sector average at 11.5. Our outlook, however, for the security is a watch. We do think the impact of Hurricane Melissa would be significant for the region, the country, and some of the companies operating within the country as well over the next few months. Many of the parishes on the western side of the country would have been significantly impacted. And the group also did indicate that consumer demand has been struggling before Melissa, and with the passage of Melissa, the impact could be further dented. So our outlook for the security is our watch at this point in time. So thanks for joining us today. If you have any questions, please feel free to give us a call. You could email us as well. And you can visit our website to see what we have in our other product offerings. Thanks for joining us this morning, and do have your